Welcome to S&P's European Loan Market video overview, detailing leveraged finance trends and activity during April 2010. I'm Suchit Gupta, a member of S&P's Leveraged Commentary and Data Team, a unit of S&P that is not affiliated with S&P Ratings. For the next few minutes, I'll walk you through a review of recent loan and high-yield bond market trends in Europe, before winding up with themes to watch for in May. As always, you can follow LCD headlines on Twitter and join our nearly 3,500 members in LCD's leveraged loan group on LinkedIn. You can get full news, stories, current and historical index files, and a look at upcoming analysis on our Facebook page. As always, before getting down to business, here's some fine print via Standard & Poor's, McGraw-Hill. Kindly read it at your own leisure. The secondary loan market showed its characteristic resilience in April despite a resurgence of the sovereign debt meltdown and volcanic fallout, literally. The high-yield market was more reactive, particularly at the end of the month. Serious concerns around the aid package for Greece, plus a downgrade of that country's sovereign rating to BB+ by S&P, led to some bumpy trading, but as with last month, supportive technicals and broadly improving fundamentals remain in place. Technicals were bolstered in April by hopes of improving repayment rates as IPOs appear on the horizon and as high-yield bond issuance rolls on. As well, money continues to flow into U.S. loan mutual funds and high-yield funds. These, of course, are good indicators of European fund flows. Improving fundamentals were seen in default rates, albeit on an issuer count, which eased again in March. The rate has receded some 4 points from its December high. As for new deal flow, activity has been geared towards the high-yield market rather than loans, as issuers take advantage of the hot bond market to refinance existing debt. Finally, the U.S. market saw its first CLO in almost 12 months towards the end of March, beginning of April, the Fraser-Sullivan transaction. And more are talked about, including a $300 million deal from Apollo. The reappearance of CLOs, even if not in the European market, is a welcome event, as it signifies that the market is slowly taking steps towards a recovery. Getting back to the secondary loan market, this chart details the average price of LCD's European Flow Name Composite, a measure of the 18 largest, most liquid loans consisting of 10 issuers since 2002. Of course, the dramatic rebound from the market meltdown of 2007-2008 is obvious. What's more, focusing on year-to-date numbers, loans returned to their resilient ways in April, despite the Greece SOVX-related market gyrations and the volcano in Iceland. Loans had a moment of weakness early in the month, breaking a 7-week rally, but ended to close April up 30 bips at 96.75. The high-yield market was more reactive, particularly at the end of the month. It was a good month for returns as well. This chart details the monthly return of S&P's European Leveraged Loan Index, the ELI, a broad measure of European loan market returns that LCD calculates. The main point here, the European loan market posted a gain of 1.84 for the 4 weeks ending April 22nd. The return was 1.82 at the end of March 2010, a turnaround from the loss of 0.56 in February. This brings the year-to-date return to 5.84 versus a loss of 7.88 for the same period last year. From the secondary, we turn to the primary. This graph details new issue volume for both leveraged loans and high-yield bonds. The European high-yield market has gone from strength to strength, though the loan market has not. Issuers have been taking advantage of the buoyant bond market to push out their maturity profiles. Indeed, approximately 67% of high-yield issuance has been to refinance debt, while 49% refinance bank debt specifically. So far this year, high-yield issuance has outpaced loan issuance by nearly 3-to-1. Though loan issuance lags high-yield issuance, there is significant loan activity with regards to the number of issuers who are in the market to amend covenants. This chart details the number of financial covenant amendment requests on an annual and quarterly basis. A financial covenant amendment is when an issuer requests a change to its covenants, whether it's an amendment to extend maturity profile, or a covenant reset, or to allow for a waiver, or allow the company to issue additional debt, or perhaps file for an IPO. This is usually in return for a fee, of course. The loan market has been underpinned by strong technicals, but fundamentals have been mixed. The default rate by principal amount actually increased from 7.69 at the end of February to 7.83 at the end of March. The default rate by issuer count decreased from 11.25 at the end of February to 10.83 at the end of March. Even though fundamentals appear mixed, default rates on a directional basis are going downwards, especially from their highs at the end of 2009. In summary, first, IPOs. Sponsors continue to prep some of their portfolio companies for an IPO. This would allow them to make distributions to their LPs. Second, companies are focused on managing their balance sheets to create financial flexibility through bond for loan takeouts or potentially through amend to extend transactions. As a result, a rise in repayment rates is anticipated due to more IPOs and bond for loan takeouts in the coming months. But the forward calendar of true new issue loan volume remains weak. This means the loan market should remain technically strong. That's the story for the leveraged finance market in April. We'll update the analysis each month and plan to have analysis of other specific European market segments going forward. Check out LCD's YouTube page for other video analysis of the leveraged finance market, including US loan market wrap-ups. For more information on LCD news or research in Europe, please contact Anna Cini. Thanks very much. We'll see you soon.